Well, just a short time ago, the Federal Reserve raised its key interest rate by 3/4 of a point, and it signaled more large rate hikes to come. So here to break down what all of this means for us is financial advisor Mike Giordano with Williams Wealth Management. Hello, nice to have you here on this Wednesday again.
I would like to come on better news days.
This is a big one, right? Because the Fed has now hiked rates a full 3 percentage points in just 6 months. Mike, when is this going to stop?
And that's what everyone wants to know. When is it going to stop? Yeah, that's the billion dollar question out there right now is when can the Federal Reserve stop hiking interest rates? They have raised them 3 percentage points off of a floor of nothing. I mean, this is like almost unprecedented. Certainly most of us have never lived through anything like this. So it is very aggressive hiking. They think they're going to have to go at least another 1.5%. But the short answer is they'll stop hiking when they see inflation coming in significantly. They don't see that really happening until at least next year.
Right. We know that's their end game. The Fed wants the economy to slow down a bit. Are we seeing any signs of that yet?
Much like everything that's happened during COVID, there's conflicting information. You're seeing stuff on both sides. You are seeing commodity prices, gasoline coming off. You're seeing shipping rates coming down and some of the supply chains starting to loosen up a little bit. But you still see housing costs far too high, and you still see jobs we're continuing to grow jobs. So they're trying to loosen up the job market a little bit, but that hasn't really happened so far. You are seeing some companies, though, start talking about how they're going to start struggling here over the next few months. And that kind of stuff is what you kind of need to start seeing.
Okay, so now to a question for all the people who like a good deal. I like a good deal. Yeah. Are there any good investments out there right now?
We all like good deals. This feels like there's nothing out there that's a good deal because it feels very scary and fearful and all those kinds of things. However, and we've rallied through this entire year where you've seen a sell-off in stocks, you've seen a sell-off in bonds. That's the bad news. The good news is now you've gotten to a place where there's more opportunities to buy stuff. So if you're a conservative investor, you're a retiree or somebody has short-term goals, you want to buy stuff and get consistent income, you can now buy bonds that are going to yield you 4, 5, 6, 7%. We weren't in that place here, in the last few years. So that's a good thing. If you are a growth investor, you want to buy tech stocks or even the S&P 500, they're off 20, 30%. So you're buying at better levels now. You just have to realize that you might still take some near-term pain.
So the big takeaway on this Wednesday, what should our number one money move be right now?
Can I give you a bundle of a number one?
Absolutely.
A number one bundle?
Please.
Okay. Number one, you want to make sure that you have that emergency fund in place. You want to have cash that's going to cover 3, 4, 5, 6 months worth of your expenses. And then you want to make sure that you're not making a bunch of mindless purchases. We all make mindless purchases, but you want to reduce those as much as possible. Cut down on that high interest debt and then continue funding your investments because compound interest can really take those investments and get it rolling. But the more you're able to continue funding them, the more energy you're pouring into that ball to let it roll down the hill.
Great advice. As always, Mike, thank you so much for being here. We appreciate it.